Hey guys, Mike here with the first episode of Bitcoin and Startups, where I'm going to talk about two of my favorite topics, honestly. Bitcoin on one hand and startups that I see as the perfect combination of value creation and value storage. And so today I'm going to focus on Bitcoin and talk about a subject that gets a lot of people riled up, especially real estate people, people who have their wealth in real estate, believe in real estate, invest in real estate. I'm here to tell you guys that there's a new kid on the block called Bitcoin, and it's a much better investment. And I'm going to show you guys why. I'm just going to share my screen, and I'll show you some numbers that I put together for this. Alrighty, cool. So I'm going to start with two real estate scenarios. One where you have an investment property, so you actually have renters that are paying down the mortgage. Another scenario where it's a home that you own and you are living in it as a primary residence. And thirdly, I'm going to show the Bitcoin scenario. So let's start. I want to show you guys my assumptions. Challenge me on the assumptions. Please let me know in the comments if I got something wrong. This is what I went with. So imagine buying a $500,000 home and we put a 20% down payment. Okay. So the down payment is 100,000. We get a $400,000 loan, mortgage rate 5%. I think this is generous. Loan term is 25 years, and we're going to skip opportunity cost of capital for now. That makes a monthly mortgage payment of $2,338. Yearly, that's $28,000. So now we're going to go into the assumptions on how much it can earn. So we're going to go with $3,000, 36K a year. All right. And we're going to skip those other two and go straight down to the costs. $5,000 in annual property taxes, $1,500 in insurance, maintenance as a percent of rent. I went with 10% of the rental amount, so to maintain it. Property management fees. If you're not actively managing it yourself and putting your time in, then you're paying someone else. And I went with 8% of the rent. And then we also have to factor in vacancy, 5%. So 1 in 20 of the months are lost. So we're going to factor that in for a total annual expense of 11,480. So that means that we have a net operating income of $24,000. Not bad. But when you factor in the cash flow after the mortgage, you actually end up in the negative 3,540 for negative cash on cash return. And in terms of, I think what's really attractive about investing in property, there's two things. One of them is that it has this appreciation rate every year. It seems, well, it fluctuates, but like on average, properties go up in price. I went with 3.5%. I did some research. After inflation, 3.5% is like the long-term rate. They actually gave 2% to 5%, so I picked the middle of those. And then the other thing is leverage, right? Because what you're really getting here that's attractive on the real estate is the leverage of putting 20% down. So when we factor those things in and your cash flow delta, you end up with something like $1 million at the end of 25 years. And when you calculate the compound annual growth rate, you end up with 10.04%, call it 10%, which is okay. I mean, here's the way I think of it, right? The S&P 500, which is like this index of the top 500 stocks, companies in the United States, returns a little bit more than that, but you don't have really anything to worry about. You just kind of set it and forget it. Whereas in this case, even though you have a property manager, you're still putting time into it, putting work into it. There's all the administrative burden and maybe like the stress that it can come with that you got to factor in. So we end up with a CAGR of 10%. What about the scenario where you buy a house and you live in it? Okay. Now, I used a down payment of zero point 0.2. Let's use 0.05 because you can do that in in Canada, your primary residence. So that means down payment $25,000, loan $475,000, so you're a little bit more leveraged. The mortgage payment is 2,776, and yearly you're paying 33,000. So what does that look like? Down here in the well, obviously you generate no rent, right? But the the taxes are the same, the insurance is the same. However, you don't pay. Actually, yeah, you would pay maintenance. Let's actually add that. That's an important one. But you wouldn't pay property management fees, so that's okay. I actually think maintenance is low. I think it's low, but anyways, we can revise that after. So let's take a look. Net operating income, we're not even going to pay attention to that because you're not really generating income from it. What we really want to look at is the bottom here. Your net cash flow is very different this time, where instead of having someone else pay for all of the expenses, you paid out of pocket. So you've paid $1 million into it. Your property is now worth 1.18, call it 1.2 million. Your net return is $178,000 versus $1 million in the first scenario. But look, because your down payment was smaller, your CAGR is 8%. Congratulations. But let's be honest, if we put this up to zero point 0.2, your CAGR goes down to 4.6%. So very, very kind of weak, I would say, considering that you can park your money in stocks and you can get a double to triple, almost triple the return. This is the moment you guys have been waiting for. What about Bitcoin? So I'm gonna unveil the Bitcoin part. Okay, we're gonna look at these assumptions, and the current price of Bitcoin is 97,000. This is a live price. With $100,000 that you would put in the rental property, it gets you 1.02 Bitcoin. And here is the power law price projection for 25 years. 23,900,000, call it $24 million. But Mike, how did you come to that number? That sounds like you pulled it out of your ass. Did I? No. I didn't pull it out of my ass. So it's actually based on science. The power law, and this is not a video on the power law, so I'm going to graze over this, but I'm going to do a dedicated video on the power law after. The power law is this phenomenon that we observe with Bitcoin. It can be measured independently by anybody. You just have to go through the data and you just have to measure it. And in nature, power laws emerge kind of spontaneously, I guess. For example, how the metabolism rates of organisms, how they scale with the size of the organism with their weight. So as organisms get bigger, they use less energy per kilogram. So in other words, cats use more energy than humans. Humans use more energy than whales. Sorry, than elephants. Elephants use more energy than whales, right, per kilogram. And as you go down, mice use way more, and keep going down, and they use a lot more. And what we found, the scientists who found this, astrophysicists actually were the first to observe this because they study planets and they look at power laws in different ways, is that Bitcoin's price is growing at a power law. And so we can actually project price fairly accurately within bands, the lower band and the higher band, and this middle one here, which is kind of like the mean. And we can project it out. Now, this particular chart doesn't go out past 2039, but I am applying in my model the power law directly. And the equation is time to the power of 5.82, if anyone wants to double check that math. But that's the power law. Bitcoin's price is a function of time to the power of 5.82. So we end up with this. I'm going to assume that we are not generating any additional yield on the Bitcoin. We are just going to sit on it for 25 years. And we end up with a CAGR, a compound annual growth rate, of 24.61%, call it 25%. So what a difference that makes, right? Because the difference between 10% and 24% is $1 million and $24 million. It's a huge difference because it's compounding. And I want to note something else. I added these here. The work done relative to real estate, how much work was done? Well, minimal. You really don't have to do anything once you get the Bitcoin and you store it away properly. Technically, you don't have to do anything, but let's say you move it around once a year. Maybe you're moving it to like more and more secure storage vaults and private keys. Fine. All right, so that takes 30 minutes per year. Security. With the house, you've got to worry about security, right? It can be broken into. I'm going to get to risk of destruction after, but how secure is your Bitcoin versus your house? Well, we can debate that, but the security on Bitcoin is very high. It can't be taken by any entity on the planet except if you want to move the Bitcoin, if it's set up right. So it has a higher security, right? If we can agree on that. What is the risk of destruction? So what's the risk of destruction with real estate? Well, let's use some extreme examples and then more common. So extreme is the LA fires, right? A fire can wash through a city and ravage a city. Hurricanes in Florida, earthquakes in you name it. Real estate, unfortunately, is subject to Mother Nature's wrath, and Bitcoin is digital gold, so it's in the digital realm, and it escapes nature's wrath the way that it's designed. And I'm going to do a video on why it's so robust, anti-fragile, and indestructible in a sense. What about mobility? Well, if I have a house, I'm stuck in the place where the house is. I could be managing it from elsewhere, but you still have this immobile asset, literally immobilier in French, immobile. Bitcoin is very high mobility. I can take it across borders. I can send it to anywhere in the world. It is not limited whatsoever. What about flexibility? This is something that I value a lot. It's flexible. I can divide it into 100,000 pieces. I can move it. I can rent it out. I can generate yield on it. I can, it's like Bruce Lee says, be like water, my friend. Bitcoin is like water, and real estate's like a rock. It is not going to move. It's not going to adapt. Well, Bitcoin can adapt, and Bitcoin can upgrade over time, which it is. So all in all, this is pretty much what I wanted to show. Compare and contrast by the numbers, real estate and Bitcoin. So when I say Bitcoin is like the 21st century investment that is going to make the curious and savvy millennials and Gen Zs very wealthy, this is what I mean by it. And when I say that people who are holding real estate are inevitably going to see the value of their real estate decline, especially in relation to Bitcoin, but also maybe in nominal terms, because people will start saying, well, I've got $1 million to deploy. Why would I invest in real estate when Bitcoin gives me 25% over 25 years? And by the way, over shorter time frames, it's way higher than that, by the way. Right now it's 60%. It's probably going to fall to, in 20 years, it's about 30%. So it's this early new asset class that just has a lot of growth ahead of it because it's superior store value, superior money. And what people don't understand is that we can't stop it. This thing is growing like a fire in cyberspace, and because of its monetary properties and qualities, investors, capital allocators are actively deciding, I will not invest here, I will invest in Bitcoin instead, because I prefer its properties. I'm going to stop the video there for today, guys. I hope it was informative. I'm going to keep doing videos like this that are a little bit longer, a little bit more in depth. Let's just stop this. And my next one, I'm probably going to talk about the power law. But we'll talk later. Cheers.